storage was booming up until that point. And booming is an understatement. Like, it got crazy. So it got 96% occupancy, rates going up. Traditionally, we'd never even hit 90% occupancy. And so all of a sudden, we're at 96% 3 years in a row.
And just jacking rates, revenues going crazy. Cap rates are freaking 4.
Everybody won. Everybody won.
Unreal.
Stupid. It didn't matter if you could operate the business. And everyone forgot about that. They forgot about operating a business. And that bubble popped. 2024 was a transitionary period into a new cycle for self-storage. During these transitionary periods, everyone, this is where you make all your money.
That lag of supply and demand is going to hit. And if you invest now, when that demand is huge and there's limited supply, you're friggin' winning.
25 and 26 are transitioning from the down market to the bull market. Welcome everybody to Self-Storage Income, and it is 2025. So Connor and I are going to talk about the state of the industry and what 2025 looks like for self-storage. You ready for this, man?
So ready for it. And I couldn't be more ready for the podcast, and I couldn't be more ready for 2025. I think there's some good things we're going to be talking about. Obviously, some pitfalls we might want to look out for, some of those different things. But I think at a high level, we've touched on some of these in previous podcasts as far as, what 2023, 2024 kind of looked like, and then moving into 2025. But I'm excited to really dive into this, get a little bit more granular as far as what we're expecting to see, because obviously a couple years prior weren't the most amazing for anybody.
Yeah.
And so 2024 was fantastic. A lot of momentum there and movement there in a lot of right directions. And I think we're going to continue to see that in 2025.
And two, what changes you need to make and expect, including what changes we have done, because we made a lot. And so, maybe we could start out with that. We can talk about the changes internally that we've made in anticipation for 2025. So traditionally, the evolution of our company has been in, we'll call it 3 stages. And those stages reflected economic and operational stages. So first of all, for everyone just listening to this podcast, maybe it's your first time watching it on YouTube. We have others that have been listening to it for years. We have the largest self-storage industry podcast, and we've been doing this for a long time. I started investing in self-storage in the early 2000s, went through 2008, and we grew to a portfolio of over 3 million square feet, over 350 million net rentable square feet. But we do all the aspects of it. And I think this is really important to know. And we have from the start. So we operate, we are owners, operators, we are builders, we do conversions, we own our tech stack, right? We do all of it. We have the sales end. So when you look at the self-storage industry, we are involved in all aspects of this. And that has put us in over these iterations and evolution of our company. We've done it because of the needs. We have pushed forward this industry in a lot of different ways with a lot of other people in this industry. We've really tried hard to work on the fact that we believe that independent operators were at risk of surviving as consolidation in the self-storage industry, which we believed would happen, which it did, and it's continuing to, and that will be a big part of the story. But we started things like Tenant. We were working and founding members of Store Local, which was an association meant to allow people, individuals, small and big operators to survive. Now, when we say that, I'm talking about an individual that maybe has 10,000 square feet in the middle of nowhere land, Midwest, to our other partners and operators that are in this that have billions of dollars. And that's right. You actually have operators that have 200 stores throughout California and others, and they believe they need those things too to survive the big REITs and what it takes to operate and perform in the industry. So it's a wider range that we've been doing and working on since a long time, decades. And that's given us a lot of insights, not just in knowledge, like we read it, right? Or we learned about it. We were operating during those times. We had to change. We had to perform. We saw customers change. We saw the landscape change. we went through essentially two real estate, I guess you could call it, downturns or crises. 2008, which was a downturn that started in the single family homes, and that trickled into everything. And then this latest downturn, which was a monetary policy initiated downturn as it contracted, interest rates went up, and that affected commercial real estate probably the most. And we're going to talk about those things and what it took for us to change and adapt. So first, the three stages we went through and what we've done today to change. And then we're going to get into our outlook, why we're making changes. We started out and it was purely an investment. That's it. It was just, we did sales. So I followed in my father's footsteps. He was like the best sales guy. He did insurance, group medical benefits, and he was like the king of it. Like, he's amazing.
Like the king of Omaha, but like king of insurance.
Yeah, exactly. Insurance. So he was awesome. So I got to learn selling insurance, right? From, I believe, the best, obviously, in the world, but it's undeniable. He was the best in our state. And so I drove around with him when I was young, and I'd go to like insurance meetings, and me and him would go through Southern Idaho, these small towns, and it was a really amazing thing. It really helped my education, and I got exposure to businesses and business models that normal people just don't. The problem with it, though, was this is commission-based sales, and the income fluctuated wildly, right? So we had, like during 2008, I lost probably 45% of my clients because they went out of business, had to make changes, and I had to resell and try to get new ones. I referred to it as the treadmill. So we invested in storage as a way to get, like a lot of people are, trying to offset W-2 income or try to create financial fruit. That was purely it. Like we needed tax benefits and we needed income that wasn't associated with that. That's all. We started doing that because at the time I was actually looking at single family and multifamily homes. This is pre-2008. We all remember what that craze was like. So it was literally, I'm like, all my friends and buddies are becoming multimillionaires buying homes. And I'm this idiot here that's living off my wife's tips that she got for working at the Chinese restaurant next to the auto body shop that we lived above. And it would literally, like in this like one bedroom like little thing, and gas fumes from paint would come in, and I was trying to sell and go to school, and I just made no money. And so like I'm like looking around going, man, I'm an idiot, right? All my buddies were just killing it. And so I wanted to do that. And luckily I had an amazing father who said, don't do that, because I couldn't make the numbers work. I was trying for years. The numbers just didn't make sense to me. I'm like, because everything we did since it was sales was cash based. We had no real assets, revenue in, revenue out, nothing else. And so I'm looking at these assets and they weren't making money, yet everybody was buying them and they were making millions. I didn't understand. I literally like, I don't know what's happening. How are you doing this? And so my dad said, well, look at this. He bought with a partner a small storage facility, and he just looked at that cash flow. And so he showed me the P&Ls. I'm like, okay, well, this makes sense. So he's like, yeah, let's go do this. And so that's how we got into storage. And this was clear back when, right? It was during a real estate cycle and bubble where storage was like, people didn't want it. It was a joke, literally a joke. Like banks are like, I don't even know how to underwrite this, right? And so everybody else was doing all this other stuff. Nobody was looking at storage. We got into it because of cash flow. We looked at it on a revenue basis, and I thought, this is a business, not a real estate asset. That became the foundation of our company. Everything. I looked around and said, I like businesses. I like mergers and acquisition. I like sales. I don't like real estate, but everybody's making millions in it. This is a real estate asset that people own, but I think it's a business, so I can buy it and increase revenue. That became not only the foundation, that became something I started talking about, and that's where we gained notoriety, because I started saying, and I started talking at like national conferences, I'm like, you all think you own a real estate asset. You don't. You own a business. Mm-hmm. And then wrote the best-selling book on it. And that evolution is interesting. When 2008 happened, everything went down. We had 6 small facilities that we'd gained prior. After that, we went really heavy into it. We used all our money. My dad and I, we worked for free for years because we were just pumping all our money and we wouldn't take anything out of our storage business. And then we sold our benefits brokerage firm, put that money in. I actually started another benefits brokerage firm, built that up and sold it to put more money in. It was like all we could do. So I was just trying to get money everywhere we could to put it in because we had a thesis that not only was economics really wildly messed up, but we could create a management company. And that's what changed. It went from an investment to saying, we're treating this and we're saying it's a business. We need to really up it. And we really need to put resources into the business, not just the assets. And i.e. Bitterroot was created. So Bitterroot, I named it after a mountain range in Idaho, but that was created as a way to have the business of self-storage be really good. That's just how we focused, all business operations. That led us to when that was the first stage. The second stage led us, and we grew wildly fast that way. We didn't have investors. This was all our own money, just repeated. So considering we didn't have investors, we didn't have outside capital, how much we grew was incredible. Now, obviously, if we'd had outside capital, I think we would have grown a lot more, but we grew a portfolio off our own backs to $150 million worth of assets. And that was, I think, probably beyond what we ever thought alone right there. Through that, the industry consolidated. Money was cheap. People saw how well it did during recessions. And then people started learning more about it. By 2016, people were like, hey, storage, this is interesting. By 2018, it started to become like a craze, right? Mm-hmm. Everybody wanted storage. And that coincided to me becoming paralyzed, hooked on life support, getting fired from my job because we'd sold our brokerage firm. So I worked for this big brokerage firm. And then getting out of it and being in a wheelchair and saying, okay, looking around, having time to say, oh, what do I do now? I'm only doing this. I'm not doing that other stuff. But really at that time, I was like, the game has changed. And it changed wildly. It became a money game, an investment game. It became more institutionalized, Wall Street. So that's when then we said, this is consolidating quickly. We need to put more resources in. This stage ended up becoming Cedar Creek. In the hospital, I was so overcome with gratitude because self-storage had saved my family. Literally. I'm like, we would have lost our home. We just had our fourth child. So I was overcome with gratitude. So I wanted others to participate and I wanted to teach others. That's where the educational platform in Cedar Creek came from. That led us up till high interest rates. Once high interest rates came, that led a new evolution. The first thing that happened that a lot of people don't know behind the scenes in these real estate cycles was me and a few other people got together and we were talking about raising capital and getting it out to other people. And we said, you know what, we're going to do this through our own. So traditionally there's a wall, and that wall is infrastructure that holds money. And that is called institutional capital, banks, funds, everything. You got to go to them to get capital, and they charge lots of money. And we said, hold on here. We want to do this, but I'm doing it for the people, not for Wall Street or the funds. And so we're trying to get directly people. Let's do this through our podcast, through social media, things like that. And so there was a group of us, I was the only one in self-storage, right? We were actually in Hawaii talking about this. We went out and we started doing this. They did it in apartments, other things. That's the first time that these things had happened back then. So we came in and raised tons of money because nobody else was doing it. It hadn't been done. And we set up this new system, which became this podcast, everything else. Me and Connor actually met with people that wanted to give us like 100 million, 250 million, and we said no to them. Now, that led us up to getting money that way to high interest rates. Storage was booming up until that point, and booming is an understatement. Like, it got crazy. So it got 96% occupancy, rates going up. Mm-hmm. Traditionally, we'd never even hit 90% occupancy, even in the boom times.
Yeah, mid-80s.
Mid-80s. That was the standard. Yeah. And so all of a sudden, we're at 96%, 3 years in a row.
And just jacking rates, revenues going crazy.
Crazy.
Cap rates are freaking 4.
Everybody won. Everybody won.
Unreal.
Stupid. It didn't matter if you could operate the business. And everyone forgot about that. They forgot about operating a business. It was just capital movement, right? And that led us to the point where I wrote a white paper and I posted on a few things in late 21, early 22. And I said, I called it the self-storage bubble. And I said, it's going to pop. Now, we were raising capital and investing. We left high growth markets. We'd done some things to formulate within our business. That popped, right? So it happened. Inflation rose. interest rates went up. They did it, and they rose interest rates all the way up, and that bubble popped. It popped for two reasons. First of all, on the asset side, cap rates can't be 4 and your interest rates at 8. So valuations went down on what they sell for. The next side, though, was what I talked about a lot when I talked about the self-storage bubble. It wasn't, interest rates make asset prices and real estate go down. That's actually not what I was talking about. It was specific to storage, because what I talked about and I showed was the housing market. Everyone was locked in like 99%. It was 98%, 30-year mortgages at 3%. So nobody would have to sell their homes. 45% of everybody gets storage. Our new customers, 45% of our new customers come from the transacting of homes. So I said the housing market wasn't going to go down. In fact, it may even stay the same or even go up, but I said it's going to stagnate and people won't move. That is like the worst thing. So I said occupancy is going to tank. And then I go, the difference between occupancy going down, which would return in dropping rates, revenue would go down. Then on top of that, interest rates would go up and what you could sell for it wouldn't be as much. That's actually what created the bubble, because not the asset prices selling, not the interest rate and asset prices. It was the functionality of revenue within storage, how easy we can drop rates, and what happens when demand goes from 96 to 87 or 86, a 10% drop. And the only way you can stave that off is by dropping rates. And that year, 22, the fall of 22, we saw that happen. 23, it was like a 20% drop. That's what brought us to the Great Transition. Are you a new self-storage investor and want to know what that facility is worth, what the risk is, how to underwrite it? Well, that's exactly what we do in a feasibility study. A feasibility study, we actually look at the market for you. We look at the finances, the underwriting, we show you where the upside is, the downside, and all the risk. That is actually what you can provide to banks to get capital and investors. It's a big worksheet, which most banks actually require. So if you want to know what a storage facility is worth that you're looking at, come to us, follow the link in the show notes, and we will tell you. The Great Transition was a down market, 22, 23, in the beginning of 24. We are now leaving and we're going into a new cycle. That was the end of a 10-year bull market run. The craziness that happened, the peak market, everything like I was talking about back in 21. Moving on from now, we are in the transitionary period. 2024 was a transitionary period into a new cycle for self-storage. Now, it's interesting, you need to remember, that big bull run was absolutely epitomized by people not only finding self-storage, but, I'm sorry, I was teaching. I know, I'm part of the problem here. Those guys. So, but operating them better and more like a business. So what that meant too was then when it happened, people were better at it and the market had consolidated. So instead of being it when we were in it, like 92% were single operators, mom and pops, by the time that 2024 came around, it was only 50%. Now that's still amazing. That's way better than other asset classes, everything else, way better. So it is going to continue to consolidate, but it paused. The consolidation really slowed down. And that's because valuations, people couldn't sell, on and on. Then what happened from there is the rates, the drop in occupancy, everything in 24, we saw that end, that plateaued. So we had two fall, which is our down seasons, rates, occupancy dropped, and busy seasons, it didn't come back. So we weren't able to really lift up occupancy that much and definitely not raise rates. 2024, that stopped. We actually saw a busy season come back in 2024, spring and summer. And we saw that come back, and then fall wasn't nearly as bad. What that means is it created a floor. 2024 was the floor. 2025 is now transiting. So what did we do in response to that? We did a few things. We focused way more on operations, which everybody had to and should have. It was actually not impossible, but it was really hard to do that when it was 96% occupied because there's no vacancy.
Everything's artificial.
It's artificial. It's not real. So we couldn't see where demand really was. You didn't build systems to get new tenants. You're trying to get people out. Like none of those needs were there. So it's not only like people got lazy, but it was what was there to do? There's no availability. There's nothing even here. So it was artificial. Demand was artificial. Once it came down, then you could see, as Warren Buffett says, you don't know who's swimming naked until the tide goes out. capital disappeared too. A lot of our competitors and people in this industry, particularly syndicator stuff, they're gone. They don't do it anymore. They literally left the business. We obviously didn't. This is all we do and all we'll ever do. And so we got to double down and go back into what things that we've been working on, like our technology platforms, all that. So our changes is 2024 was a change of stabilization and then us reallocating assets and resources into known strategies that work today, not back in 2016, right? And it is new. It's different. Customers are different. And so we've been working really hard as we're looking at all these things. Now, as you're listening to this, you may go, this is overwhelming. This is a big portfolio industry stuff. Individually, this is way different, small markets things. We're going to talk about that. But for us, we have a large portfolio across a lot of states. We then started to change even our companies. So we consolidated management companies and everything into one, Cedar Creek. It's just one operating company now. Bitterroot, everything else is all one into Cedar Creek. So we're completely directly aligned. And we also have rolled out our new technology platforms and what we're doing there. So we can focus on operations. We also changed to move from trying to stop down and trying to stop bleeding, everything else like that, to no growth. So now we're rolling into 25 under a completely growth mindset. During these transitionary periods, everyone, this is where you make all your money. So it's not when the markets actually go up. So when you hit those top markets crazy, like 2018 to 2022, right? The people that won were the people that had the assets from 2012 to 2016 during the transitionary period. We're in that period. 25 and 26 are transitioning from the down market to the bull market, to the up market. So we're already seeing that in our assets. The market will respond and move accordingly, but there's less competition. That means sellers have less people to buy from, so you can get great deals. That means that there's more upside, whereas in 22, there's downside. So all of these things line up for an amazing, perfect storm into 25 and 2016. Because on top of that, high interest rates limit development. Not as much inventory can go to the market. So that brings down supply, which then stabilizes demand. And then when demand goes back up, it makes it big. And then you're raising rents big, everything else. So that's what we're leading into right now. We're leading into this transitionary period in this industry. And it's very exciting.
Dude, that's what I'm so excited for, is that dynamic of the supply-demand lag with development specifically, which is where, like, investors, if you're thinking about investing in developments, it's now.
It's now.
Because that lag of supply and demand is going to hit. And if you invest now, when
you're cleaning it up,
demand is huge and there's limited supply, you're friggin' winning. And that's exactly where we're at.
For example, in 2023, we still saw all this development coming on. All these developments were coming out, even though occupancy and rents were dropping. And people are like, well, why did they develop? Well, they made the decision 3 years prior. So they got the money. They started building everything else literally 2-3 years prior. So they're just finishing in a 3-year cycle in the downturn.
Couldn't stop.
They couldn't stop. Yeah, nothing they could do. But then also that lag continues the other way. All the deals that say we're no longer going to develop, we're no longer going to build, banks start pulling back capital and say we're not going to give you capital for this project in this location anymore because we don't want risk. That then creates 3 years of less development. 2024, especially in the beginning, we saw the tail end of development. Now, the end of 2024, that's really where all of a sudden it was like, I'm not seeing storage facilities pop up anymore. So 2025, 2026, right? That's continuation. Now, people will build, obviously. It's the rate. I mean, how they were building prior, 2021, 2, and 3 were wild. So much development coming out. That has really gone down. People have to be much more selective on development, everything else. So you're building now. If you come into development and build now in a good spot, not very many people are going to be doing it. That's a huge opportunity advantage. And that also then leads back to, if you own an asset or if you're buying in a market, a lot of people can't build. So you have markets. For everybody listening to this, you have 3 different types of markets. You have your Class A big ones, right? LA, New York, right? The big boys, the millions of people, huge, vast international airports. Then you have the second tier markets, which are still big ones. Think Austin, right? Some of the markets are debated whether they're first or not. I think Nashville, Austin, right? These big markets, but they're not huge. They're not crazy, right? Then you have small markets. Now, small markets has the biggest variation. And a lot of people get this mixed up. Because when you say a small market, some people think that's 200,000 people. Other people think that's 5,000 people.
Right.
That's a big, big difference. So when you go into this third basket, generally people aren't even thinking about the fourth one because people are invest. When you get into this third and fourth basket, which is where most people that are probably listening to this podcast will invest, that's where we started out investing and we still have assets in those markets, right? It's really hard to develop. Banks don't want to give you money to develop because occupancies aren't amazing, but the rents to what it costs to build don't make sense. That gives you what I call my rate runway. The rate runway is rents have to go up a certain amount until it makes sense to build. That rate runway is how much the rates will go up until building makes sense. So if I'm buying and they're getting, let's say, whatever it is, I'm going to make this up, $10 a year per square foot in rent. But if I have to build at today's cost, everything else, and interest rates, I can't make it till $20 a square foot a year to build. That means my rates can double until new supply comes on. There's a lot of markets like this where it's literally not feasible. So you go, if that market's growing, that growth is going to you and you'll be able to raise prices. This is what we see then overall in the market. People stop building, markets grow. That supply outpaces demand, occupancies rise, rents then start to rise, then people come in to build. But there's that tell. So this transitionary period goes until that all catches up, and then the building cycle starts everything else again. It's very exciting because you can make a lot of money. But two, this is where the opportunities are. Mm-hmm. This is when you find opportunities. Technology is the name of the game, and how you operate your facility and the efficiency at which you can operate will depend on the technology you use. Your property management system, what it allows you to do, and what you have access will determine the outcome of how that facility performs. That's why we go with Tenant Inc. with their product Hummingbird, because they are the best in class. When dealing with automation, when dealing with move-ins, customer acquisition process, improving my online acquisition process, they are bar none the best. So if you are looking to automate your facility or operate it in a best-in-class way, make sure you guys are looking at Tenant Inc. and their product Hummingbird. The link is in the description. It's not easier. This is important. People think that it's easy back in 2021. Well, that's because everybody sold because you paid such a stupid price that everybody's like, yeah, I'll sell. And money was so easy. Everybody had money. Banks were lending money. Everybody was selling. That's easy to transact. That actually doesn't mean it's easy to make money, because that doesn't mean the deals are good. That's a market driven, just appreciation, right? Today, it may be harder to find money or to get a bank to lend, things like that, but definitely not impossible. That people love storage now. When it was 2008, it was impossible. And before that, it was really hard to get banks along.
Man, if you guys could, at that point in time, in the 2008 time frame, after that cycle had happened, if you guys could go out, find the capital, find the deals, put things together, yeah, the barriers of entry were there. You know, there wasn't the lending, there wasn't the information like these podcasts we've got now today. There wasn't any of that. But I mean, now there's like the most opportunity ever to execute. The information's there. Banks know about it. It's institutionalized. It's like everything is there and ready. Like, yeah, you got to find some capital. Yeah, you might have to find a partner.
You always have to do that.
Yeah, like that's not going away.
Yeah, exactly. Like, yet now you have all the resources.
Yeah.
And two, people know. Try to convince somebody back in 2010 to invest in a storage facility. First of all, they're like, I've never used one of those. How does that work?
Yeah.
And then second of all, they're like, you realize that we're in a real estate depression, right? Like even then prior to that, try to find somebody to invest in storage. They're like, why would I do that?
Can't
like,
imagine.
Yeah, it's just like now today, everybody is interested in storage. And two, you have all the information. Like I just put out a freaking Bible, whatever, 430 pages.
It's hefty.
It's hefty, exactly how to do it. And that's why it became a bestseller, everything else, because it was here, literally here, whole entire thing. Here's your playbook, everything you need to know.
You got banks like Live Oak that are, I mean, they're structured and have departments just for storage.
To do this.
It's amazing.
And they'll actually help you. They know. So members of our community, we actually team up. So we bring our deals to them. But Live Oak Bank, they underwrite those deals. So they're actually working side by side to help people get into deals. These things, they did not exist. And so I think a lot of times we look back and say, oh, it was better then, or it was easier then, or there wasn't high interest rates then and everything. First of all, that's actually not true. If you go back when interest rates rose, so prior to 2008, under 5%, that was unheard of. Like that didn't even make sense. 6% was normal, 6.5%, especially for these types of assets. So we're getting actually interest rates similar to what we were getting during those periods. There may be a point difference on the upside, but once again, that still existed. So today you have the ability, the knowledge, the tools, the resources. Right now, today, if you wanted to operate yourself or had to, I mean, do you know how many companies are out there that are tech companies, everything else to help you? Back then, we had to create a management company because there was no other way. We literally couldn't do it. If you didn't manage that asset 100% yourself, you couldn't own it. It didn't work. So there was no third-party management, but there was also no resources to. There was no online marketing. You know what we did? Kids, we put a thing in the yellow pages. That's why everybody's AAA storage. It's because they wanted to be the first in the page of the yellow pages. So hopefully somebody finds you.
Like Google ranking, but
that was marketing.
Old school.
And nobody was there to help you. It was just you put it up and you hope people came by and rented the unit. So today you have unlimited amount of help potential. There was no podcast. There's no educational. It's amazing because we're now in a cycle where there's opportunities and these cycles benefit beginners, not the big boys. So if you look at the big boys, you know why we haven't seen in years, like all these $1 billion purchases and all this stuff. I mean, this cycle is not good for those people. It's really good for beginners, small deals, and people starting out because those sellers have to sell. And two, they don't get to hold out for big money to sell at a 4 cap. They can't. So the difference that we're seeing, a big asset, institutionalized size, grade, and quality, that'll sell at a 4 cap today. Still, even though interest rates are 6.5, 7. Because the people that buy it, their money works differently. And those owners, they don't need to sell it for less. The rest of the market, when you get into 3rd, 4th tier markets, no, we're buying those at 8 caps. Think about that spread. That is an incredible spread in what you're purchasing something for. You know, that's a 50% difference. That's wild. So this market cycle benefits you. When we're going out and I'm trying to find deals now, right? I'm selling deals at 5s and 4 caps. I'm trying to negotiate at this level. But when we go down market, no, it's like the deals that we're bringing to our inner circle and community, they're 7 to 9 caps.
It's amazing.
It's amazing. And two, they're doing seller financing. Seller financing didn't exist. All of those things exist going into 2025. But guess what? We're not seeing the drop in rates and rents anymore. That's why it's a perfect storm. The opportunity exists, but the downside has stabilized. I'm so excited for 2025. This 2025 and 2026, the reason why we've consolidated our companies, the reason why we're talking about it, the investment we're bringing in, because these are breakout times that break you out and separate you from the pack, everybody else for a decade. And so everybody listening to this, and I've told staff everything else, I go, we have definitely 2025, maybe even 2026, where it's like, we need to make hay. Like we got to work our brains out to find deals, buy deals, because this is the time, right? And we're buying deals, we're finding them. 2023, did we even buy one deal? Or 2020,
yes.
2023.
One, barely. Yeah, we had one.
One deal.
Yeah, decent deal. I mean, but 2024, I mean, we just closed Monday on an incredible deal. Expansion potential, checking all the boxes, growth, area of growth. I mean, incredible deal.
Yes.
And I mean, we're looking at also improving assets that we currently have and how we can do that in these up times as well to, again, not only build for today, but build for the future and upgrade facilities, all the things really, really important to think about. With that said, AJ, what are some of the barriers? Like 2025 is looking great, maybe 2026, like you said. What are some of the barriers of entry that people can expect, and how can they overcome those? How can they prepare for those and have the ingredients in the recipe for success?
Yeah, your barriers of entry are going to be way more traditional things, such as individual markets that are still oversupplied because of building. Okay. So first of all, the number one thing that matters and will always matter is the market. I say this endlessly. You could be the smartest storage operator in the world, and if the market's bad, you're not going to do good. You could be an idiot, and if the market's going to do good, you're going to be successful, right? So if you're really smart and know what you're doing and in a good market, that's amazing. And if you're really smart and know what you're doing, you won't get hit nearly as hard in the down markets, but you can't beat markets, right? If it's oversupplied, it's oversupplied. There's certain things you can do to offset the range and the damage, right? Or capitalize on the upside, but you just can't beat it. So that's the first thing. Just make sure that the market, people are full, that there's demand, okay? And not all markets are treated equally. We're in a traditional real estate cycle. Get that off the table. The barriers of entry that you're going to have is, first of all, capital. Now, once again, though, this is always a problem, but it's not nearly a problem like it is in the past. Why? Because people know about storage, they're interested in it, and there's opportunity to go out and get it, present it, and you can go talk to people. Why? Because we have the internet, we have real estate groups, we have communities, all of those things. The education to do it, on and on and on. But it is still a barrier because people are much more careful. They're much more risk adverse than they have been during the bull markets. When I look at the barriers, for me, it means that you have to work harder to get over them. So the barriers on capital have gone up. They just have, right? It's harder, but that's also why the opportunities are better. And so they're not impossible at all. And two, this is something you have to overcome anyways. Now, the next side is the deals. Traditional deals and brokerages, sending out deals, everything else that are just everywhere, all over the place. That's not true. There's less deals, right? And so you have to network, you have to go out and direct outreach, you have to work harder to find deals. Once again, though, this barrier may have gone up, but also you have to look at it from the other perspective. Just because deals were available didn't mean they were good. Mm-hmm. So I actually think that it's easier to find good deals today by far than it was in 2022, 19, because you didn't know. You didn't even hardly know. Everything was just full. Everybody was building, but they were filling up it, and you were paying these high prices. So whether you were actually getting a good deal or not, it hadn't been stress tested. So today it's very clear. You know, right? That's the key is you just know today. You didn't know 3 years ago. So those barriers have gone up, but it doesn't even necessarily mean that it's bad. Mm-hmm. So when I look at the money, when I look at deals, this is all about networking. This is all about increasing your overall circle of influences. This is about finding out where, how. So education, community, networking, all this is so important right now because those things consolidate more, right? And they go to certain places. Perfect example is Live Oak Bank. Lots of banks, if you haven't done this, you're buying a first deal, they don't know storage. They don't specialize in it. So they look at you as risky and they go, I don't know how to do this. I don't know how to really underwrite this. So if you've never done this, I don't trust you. Whereas you have certain banks like Live Oak Bank that we talked about because they partner up and they do underwrite it. And they can do SBA loans and they have the underwriting power for the government. So they don't even need to send it. They know that it's going to be approved. Quality is what's important today. Quality of help, resources, education, right? Mm-hmm. So preparation, taking time, right? Going and doing the work to find the deals, to network, find the money, right? To find a banking partner, really important. The other side is operations. The biggest barrier that you have is competing for new customers. This is where tech is so important. Our customers today, 85+%, come to us from our cell phones. Even if they see you when they drive by, They go, oh, I want to go there. How do they find out about you? Their cell phone. So even if it is a drive-by, it's a drive-by that accessed you from their phone. So this becomes really important in your marketing, your advertising, and your tech, so you can compete and you can stay afloat. This is why with like Tenant and our marketing, we spend so much time and money to understand this. It's also because the cost of it has gone up as an ad spend. So Google charges us more, right? If you're in areas where nobody's really doing online marketing and doesn't have good services, this is really easy. But once again, everybody, it's important. It's not necessarily even that we do that. We partner up with the people that do that, and we use them as a service. So these barriers, first of all, doesn't even mean they're a bad thing. In some cases, like deals, I actually believe it's better. Money, right, is more scarce, but it's more focused. Mm-hmm. People want to invest in storage. People want, so you can go to those things. Banks, you know, and you can see the lenders, and they can actually help you. So it is a team sport, and that really shines. The biggest barrier is scale. If you're trying to go raise $100 million and deploy it, that is tough. That is, honestly, that's the case we're in. That is much harder because I got to find lots of deals. They got to be great deals. I got to operate and perform in a super competitive market. I'm much more subject to certain things. If I'm buying 1 or 2 deals, that's not nearly as difficult today. Because the guys that have to do what I'm doing, they buy certain types of deals, right? I need 80,000 square feet. I need a good market, all this kind of stuff. Our buy box is smaller. If you're buying small deals, mom and pop, you actually have more options. So the market has separated. It's not the same thing. So when you hear a lot of times, and I have an issue with this, when you see the news and when people are stating what's going on in the market, they're not talking about the market. They're looking at the REITs. They're looking at literally, you have 30 cities in the United States and publicly traded companies that represent like 30% of the market. Mm-hmm. And that's what they're talking about.
In all these different markets. They're not talking about the markets, competitive, the deals that you're in. They don't discuss that. So when Wall Street talks about the self-storage industry or market, they're looking at things that actually probably don't really apply to you. And so a lot of people get confused by this. And a lot of people are weary of this. But it's a 3-mile game, people. Mm-hmm. This is localized. When they say, oh, storage deals are still trading at a 4.5 or a 5 cap, they're not unless you're in these big cities, unless you're REITs, everything else like that. No, they're not, right? And so when you look at overbuilt markets, most smaller markets in the United States are not overbuilt, because nobody's built there. So be careful with that. That's why we try to talk to you guys about what's actually happening on the ground, what's actually seeing, not something we read in an annual report from Public Storage. Mm-hmm. And so I take my 5 big publicly traded companies, I read their annual reports, and then I say, this is what the market's doing. They don't represent the market for all of us. They just don't. Yeah, there's just no way.
No, there's no way. No. And sometimes that can be worse. Sometimes that can be better, right? But we want to give you on the ground what's happening, how to capitalize on opportunities that is actually meaningful, that is real. And so 2025, be very aware of that. When you read a headline in the Wall Street Journal, that does not mean they're talking about assets or markets that you're looking into. It's not the same. And 2025 is a transitionary year. People are weary just because of the past, high interest rates, everything else. The people that aren't, that understand the business, we're all buying. People that are in this business that really understand it, we're all buying. The people that are coming and going, or just asset traders or syndicators, right, that aren't storage businesses, they're the ones that are weary, right? That speaks a lot to me. And guess what? The guys that are in the storage business, they're the ones that make the most returns. The other ones are just like trading. They're playing Wall Street games. And so they're taking advantage. They're going all in, right? I think that's a really important thing to remember in 2025. The hurdles that you have are hurdles that, first of all, don't expect to go away. Mm-hmm. Don't expect interest rates to go back down to 3%. Don't expect all of a sudden everybody just try to sell their deals and you can just buy any deals and banks are going. Don't expect that to go away in 25, 6, 7, 8. And I talk about this a lot where people are like, I'm like, well, what are you waiting for? The market to change. Like when you say the market to change, what are you waiting for it to change? Well, I'm waiting for good deals. How is there not good deals today? What does that even mean, right? Well, interest rates to come down. All right, so if interest rates go down to 3%, then the price of that asset that you want just went up $1 million.
And the competition just went up.
The competition went up. So then you're going to say during that time, there's too much competition and prices are too high. So the question once again is, what are you waiting for change?
Yeah.
Don't wait for the market to change. The market's giving you the advantages and giving you what you actually want. You want it to change so it's easy. It doesn't work.
Yeah.
It doesn't work like
It's not going to be easy.
when it's easy,
Ever.
you can't compete.
Exactly.
So it's not easy. It's actually almost impossible at that point. This is the time for the vast majority of smaller operators that are buying one single small facility to bigger facilities or trying to put a portfolio together, right? And this could be literally tens of millions, even hundreds of millions of dollars. This is the time for these people and these operators. The barriers help you.
They truly do, man. I'm super jacked for 2025. Looking forward to the year, man. And I mean, if anybody can take anything away from this podcast, 2025, it's freaking go time, man.
It's go time.
Get out there and crush it.
And we'll keep you updated with all the crazy changes that are coming because we don't know what will happen. And that's okay. We don't expect to.
Exactly.
We're still buying and still moving forward. Thanks, everybody.
Thanks, guys.